Welcome to Capital Allocation Lab.
Subscribe and like to support more educational episodes.
Today, we are walking into the lab with a very specific subject on the table. We are looking at Netflix, but we aren't here to talk about the latest hit series, the algorithms, or, to debate the cultural impact of streaming wars.
Not at all.
We are here to do something colder, more forensic, and frankly, much more disciplined. We are going to conduct a Graham-style margin of safety stress test,
Right.
combined with a Buffett-style check on business quality. And we are going to do it grounded strictly in the numbers that are actually reported.
That is the key. The narrative around this company is often loud. It's about subscribers, hits, and awards.
Yeah.
But the numbers tell a very specific, quieter story.
Yeah.
The core theme we are looking at today is attention. The operating results look strong. There's no denying that. But the valuation metrics are extreme.
Very extreme.
So the central question for us isn't the usual, is this a good company? We are moving past that. The question we need to answer is, what can go wrong, and how much of that risk is already reflected in the share price?
Exactly. It is about pricing risk. Before we open up the books, we need to state our disclaimer. This is educational content only.
Yes.
This is not individualized investment, legal, tax, or accounting advice. We are exploring a case study, not telling you what to do with your portfolio.
Okay, so let's get our inputs set up. To run any kind of valuation model, we need to agree on the fixed points of data we are using. These are the inputs that drive every other calculation we're going to do today.
Right. For this analysis, we are using a specific share price of $84.
$84, okay.
We are looking at a shares outstanding of 4,244,550,000.
That's a lot of shares.
It is. And if you run the math on that, price times shares, you get an implied market cap of approximately $356.5 billion.
$156.5 billion, a huge company. And I have a few important housekeeping notes regarding the source documents we are analyzing. Okay, first, the financial statements we are reviewing are unaudited. Second, when you look at the raw data tables, most line items are presented in thousands.
Right, so you have to add 3 zeros.
Exactly. For our discussion, we are going to mentally convert those to billions to make it digestible. But the raw data is in thousands.
Good point.
And one final crucial detail. The per-share amounts have been retroactively adjusted for a 10-for-1 stock split effective November 14, 2025.
That split adjustment is vital for anyone comparing these numbers to historical data from a few years ago. If you pull up a chart from 2024 without adjusting, you're going to be very confused.
Totally. It creates an optical illusion of a lower price, but the valuation ratios, the things we're about to talk about, remain the same.
Okay, let's get into the meat of it. We call this section the Outlier Scoreboard.
Right, and this is the concept of outliers. When you are conducting a review through the lens of Benjamin Graham, the father of value investing, the biggest danger isn't necessarily buying a bad business. The danger is paying a price that allows no room for adversity.
No margin of safety.
Exactly. You want to identify where the metrics are screaming optimism so loud that any slip-up becomes a disaster. We are looking for the numbers that stand out as abnormal.
So let's read the scoreboard of the fiscal year 2025 reported results to establish our baseline. This is what the business actually did. Revenue came in at $45.183 billion.
$45.183 billion.
Operating income was $13.327 billion. Net income stood at $10.981 billion. And diluted earnings per share, or EPS, was $2.53.
Those are the headline profit numbers. But as we know, earnings can be subject to accounting treatments.
Yeah.
What about the cash? What actually hit the bank account?
Good question. Cash from operations, or CFO, was $10.149 billion.
Okay, so a little less than net income. We'll come back to that.
A little less, yeah. Non-GAAP free cash flow, or FCF, was $9.461 billion.
Still a huge number.
Huge. And looking at capital returns, share repurchases were $9.127 billion.
Wow. Okay, that is a massive number relative to the cash flow, which we will definitely discuss later. It signals a very specific management strategy.
It does. Now, what does the balance sheet look like? What does the company own, and what does it owe?
The snapshot in time.
Exactly. Cash and equivalents sat at $9.034 billion. Total debt was $14.463 billion.
So more debt than cash.
More debt than cash. Stockholders' equity was $26.615 billion. And a very specific line item for this industry. Content assets, net, were $32.778 billion.
Okay, those are the fundamentals. Revenue, income, cash, assets. Now, we have to transition to the stress test.
This is it.
We need to compare these fundamentals against that $84 stock price and the $356.5 billion market cap. This is where the outliers start to appear. We are looking for the friction between the business reality and the market's expectation.
Let's walk through these calculated valuation outliers step by step. First, the price-to-earnings ratio, the PE.
The classic.
We take the stock price of $84 and divide by the diluted EPS of $2.53. That gives us 33.2x.
33.2.
That is outlier number 1, 33x earnings.
And in a Graham framework, 33 times earnings is a heavy, heavy multiple. It implies a long duration of sustained growth.
Right.
It essentially says the market is willing to wait 33 years for the company to earn back its purchase price at current levels. It assumes that nothing will interrupt the earnings stream for decades.
It's a big assumption. Okay, next up, price to book. We take the market cap of $356.5 billion and divide it by the stockholders' equity of $26.615 billion.
And the result there?
The result is approximately 13.4x.
13.4 times book value.
That is outlier number 2, 13x book. That is an incredibly high premium over the equity capital invested in the business.
It really is. It suggests the market believes the intangible value of the brand, the subscriber base, is worth 13 times the net assets on the books. Usually for a defensive investor, you want that number much closer to 1.5 or 2.
Not even the same ballpark.
No. Now let's look at price to sales. So that's the $356.5 billion market cap divided by $45.3 billion in revenue.
Right.
That comes out to approximately 7.9x.
Almost 8.
Outlier number 3, almost 8x sales. For a mature company, paying 8 times revenue is steep. Usually you see that in early-stage software, not media at scale.
Yeah, that implies that every dollar of sales is incredibly valuable, which is only true if margins are massive.
Exactly. Which leads us to the cash.
And that brings us to the cash yield, which is often where the rubber meets the road for conservative investors. We look at the free cash flow yield. We take the free cash flow of $9.41 billion and divide it by the market cap of $356.5 billion. The result is 2.65%.
A 2.65% yield. In a world where you might get risk-free rates higher than that, you have to ask yourself, why accept 2.65%?
Well, the only reason is you believe that number is going to grow fast.
You accept it only if you believe that yield is going to grow rapidly. And if you flip that upside down to get a multiple price to free cash flow, it is the inverse of the yield.
Right, and that gives us approximately 37.7x.
Almost 38 times.
That is outlier number 4. A low cash yield implying very high future expectations. You are paying nearly $38 for every $1 of free cash flow the company generates today.
That is a price that demands perfection.
It really does.
And context is everything here. These valuation multiples, 33 times earnings, 38 times cash flow, don't exist in a vacuum. They are supported by the company's profitability margins. The only reason the market accepts these prices is because the margins are currently extraordinary.
Right, and the margins are impressive. Gross margin is approximately 48.5%.
Nearly 50 cents on the dollar.
Operating margin is approximately 29.5%, and net margin is approximately 24.3%.
Those are very high. An operating margin of nearly 30% and a net margin of over 24% are stellar. But here's the risk context. At this extreme valuation, that current margin structure is the load-bearing wall. The stock price is resting heavily on the assumption that these margins are not just peak margins, but permanent floors. If that wall cracks, the valuation comes down. Hard.
That leads us perfectly into our next segment, the required performance test. This is a shift in perspective.
Right.
Usually people ask, is the company doing well? But we need to ask, what does the price demand? What does an $84 stock price require the company to do just to justify itself?
Let's apply a classic Graham yardstick. Graham often suggested a multiple of 15 times earnings for a moderate defensive valuation.
A reasonable baseline.
Right. If you pay 15 times earnings, you're getting a roughly 6.6% earnings yield, which is a decent starting point.
Okay, let's run that math to see the gap. The price is $84. To justify that price at a 15 times multiple, you would need earnings of, 84 divided by 15. You need an EPS of $5.60.
$5.60. Now compare that to the actual reported EPS.
The reported EPS is $2.53.
Wow.
So the market price is demanding earnings that are more than double what the company is currently generating just to fit a standard 15 times valuation box.
So you're not paying for today?
No. The price is already paying for a doubling of the business.
And even if we are generous, Let's say we allow for a quality premium, because it's a dominant business, and we use a relaxed 20 times multiple.
Okay, a 20 PE. At a 20 times multiple, the required EPS is $4.20. We are still far above the actuals of $2.53.
Still nowhere close.
The gap between what the company earns and what the price expects it to earn is massive. You're paying for tomorrow's earnings today.
Let's apply the same logic to cash flow. Cash is often harder to manipulate than earnings. First, let's figure out the free cash flow per share.
Okay.
We have total FCF of $9.461 billion divided by 4.445 billion shares. That gives us approximately $2.23 of free cash flow per share.
So for every share you hold, the business generates $2.23 in cold hard cash.
Right. Now, if you are buying that stream of cash at $84, what kind of yield are you getting? We know it's 2.65%. But what should you demand?
Right. What's a reasonable return?
To justify $84 at a conservative 4% yield, you would need the company to generate $3.36 in FCF per share.
And we are currently at $2.23.
Exactly. And if you wanted a 6% yield, which is a more traditional target for a mature business to provide a margin of safety, you would need $5.04 in FCF per share.
More than double the current cash flow.
So the price assumes one of two things. Either the company is going to materially increase that free cash flow in the future, more than doubling it to reach that 6% yield target,
right,
or investors are willing to permanently accept a low yield because they believe the business is so exceptional that normal rules of return don't apply.
That is the definition of a glamour stock pricing. It relies on the future being significantly better than the present. It relies on momentum.
Which brings us to the durability of those margins.
Yeah.
We mentioned the load-bearing wall. Let's look at margin fragility and risk.
Okay.
We have to analyze the trend here. Margins haven't always been this high. They have stepped up significantly.
They've really expanded.
If you look back at the 2021 to 2023 period, the operating margin hovered in the approximately 18% to 21% range.
Right, I remember that.
Now, in 2025, it sits at 29.5%. Similarly, the net margin moved from the mid-teens historically to 24.3% in 2025.
That is a massive improvement in efficiency and operating leverage. They have managed to keep costs relatively flat while revenue grew. But here is Graham's principle. Premium prices demand premium certainty.
Exactly.
When you pay a premium price based on peak margins, you need to be certain those margins are durable.
And high margins are inherently fragile. They act like a beacon, they attract competition, they create internal pressure. We need to identify the specific downside pathways. What could cause that margin to compress?
Well, costs could go up.
Cost pressures are one. Competitive spending, having to spend more on content to keep subscribers, is another.
The content arms race.
It's content arms race. Content economics can shift. Foreign exchange or FX shifts can hurt when you are a global reporter. Or simply a reversal of operating leverage. If growth slows, fixed costs eat up more of the revenue.
The danger is the multiplier effect. At an extreme valuation like 33 times earnings, even a normal margin pullback causes an outsized drop in fair value.
It's a double whammy.
It is. If margins drop back to 20%, earnings drop significantly, and the multiple likely contracts at the same time. You get lower earnings and a lower multiple on those earnings, a recipe for a big price decline.
So now let's look under the hood. We need to do an earnings quality check. This is the forensic part. We need to see if the reported net income is backed by actual cash or if it's just accounting magic. Is the profit real?
Okay, so we compare net income to cash from operations, or CFO. Net income is $10.981 billion.
$10.981 billion.
And CFO is $10.149 billion.
So slightly less.
The ratio CFO divided by net income is approximately 0.92x.
What is the interpretation there? It is less than 1, which means cash flow is slightly lower than reported earnings. It is not a red siren. It's not, 0.5. But it means cash is not wildly above earnings.
Right.
The company isn't secretly generating massive excess cash that the income statement misses. The earnings quality is decent, but not aggressive.
Let's look at the free cash flow conversion.
Okay.
FCF divided by net income is approximately 0.86x. And we should note the definition used here. Non-JAPE FCF is defined as CFO minus purchases of property and equipment.
So the conclusion is that the cash conversion is strong, but not magic. It confirms that the business consumes cash to grow.
It has to spend money to make money.
Exactly. And you must watch the sensitivity to content investment cycles. If they decide to ramp up content spending, that cash number could drop faster than the earnings number because content spend hits cash flow immediately but is amortized over time in earnings. That 0.86 ratio could deteriorate quickly in an investment cycle.
That is a crucial distinction. Now let's move to the balance sheet. This is where Graham really starts to frown. We call this balance sheet discipline, the Graham no.
Graham was, first and foremost, a credit analyst. He wanted to know if a company could survive a storm. He applied strict defensive tests. He didn't care about the upside until he was sure the downside was covered.
Let's run the current ratio test. This measures liquidity. Can you pay your short-term bills?
Right.
Current assets are $13.020 billion. Current liabilities are $10.981 billion. You divide assets by liabilities and you get a current ratio of 1.9.
1.19. Is that a pass or fail?
For a Graham defensive investor who requires a ratio of greater than or equal to 2.0, it is a hard fail.
Not even close.
Even for an enterprising investor who might accept 1.5, it is a fail. 1.19 implies a very tight liquidity position. It suggests they're running the business lean on cash, likely relying on incoming revenue to pay outgoing obligations. There is very little slack in the system.
Okay, what about debt? Let's look at the debt. The debt versus net current assets, NCA test.
Yeah.
First, we calculate net current assets. That is current assets of $13.02 billion minus current liabilities of $10.981 billion. That gives us $2.039 billion of working capital.
So just over $2 billion.
Now, compare that to long-term debt, which is $13.464 billion.
Yeah, the long-term debt is far above the net current assets. In fact, it is 6.6 times higher.
That is a fail.
Okay.
A classic Graham balance sheet, no. He wanted to see debt covered by working capital, or at least manageable relative to it.
This is the opposite.
Right. Here, the debt load is significant relative to the liquid assets. It means the company is leveraged, relying on future cash flows to service that debt rather than having cash on hand to extinguish it.
And there is another structural risk on the balance sheet, asset concentration risk.
Ooh, this is a big one for media.
It is. We mentioned earlier that content assets net are $32.778 billion. Total assets are $55.597 billion. When you do the math, approximately 59% of the company's total assets are tied up in content.
Think about what that means. The majority of the company's value on the books is in TV shows and movies. The forensic question is, what would impairments look like in a stressed scenario?
If a bunch of shows just flop.
Exactly. If audiences shift, or if older content loses value faster than expected, those assets have to be written down. We have a data gap here. We lack the detailed nerds to stress test this. But the concentration itself is a risk factor. It is an intangible asset base.
Very much so. Let's talk about how the company uses the cash it does generate. Section 8, capital allocation, buybacks and dilution.
This is about management's behavior. What are they doing with the shareholders' money? Are they reinvesting, paying dividends, or buying back stock?
We saw that free cash flow, FCF, was $9.461 billion, and we saw share repurchases were $9.127 billion.
Almost identical numbers.
Almost identical. Let's look at that ratio. Approximately 96.5% of all free cash flow generated in 2025 was used for buybacks.
The implication is clear. Buybacks are the dominant shareholder return engine. They aren't paying dividends. They're funneling almost every spare dollar back into buying their own stock.
The risk here goes back to valuation. Buying back stock is great when the stock is cheap. If you buy $1 for 50 cents, that's brilliant.
Of course.
But buying back stock at 37.7x FCF, that raises the bar for value creation significantly. You are buying out partners at a very high price. You are essentially betting the farm that the stock will go even higher.
And we have to talk about the dilution factor. You can't just look at buybacks in isolation. The cash flow statement shows proceeds from issuance of common stock of base $667 billion.
So new cash is coming in from issuing stock.
Right. And it also shows stock-based compensation of $0.368 billion. So new shares are being created and issued to employees. The buybacks must first overcome this ongoing dilution before they start reducing the share count and creating per-share progress.
It's like running up a down escalator. You have to run faster than the steps are coming down just to stay in place.
That's a perfect analogy.
Yeah.
You have to spend billions just to offset the shares being created internally.
A very apt analogy. Now let's look at some regional and FX nuances. These are often overlooked.
These are the quiet signals in the regional information provided in the source documents.
The company reports both reported and constant currency revenue changes. They explicitly note hedging, gains, losses included in revenues.
This tells us that the revenue number isn't just pure customer payments. It's affected by currency swings and the hedging contracts used to manage them.
A bit of financial engineering in there.
A little bit. We also have an FX-neutral margin bridge. The as-reported operating margin is 29.5%.
Right.
The adjusted FX-neutral operating margin is approximately 29.35%.
So in this specific period, the difference is small.
Very small.
But the conclusion is that FX isn't changing the headline story today. However, at these high margins, small currency forces are worth monitoring. A massive swing in the dollar could eat into that margin cushion quickly. It reminds us that this is a global business exposed to global currency risks.
Let's bring it all together. We have run the numbers. Now we need the verdict. Let's go through the Graham checklist. These are binary pass-fail tests.
We will start with the defensive investor checklist. This is the strictest standard designed for, widows and orphans investors who cannot afford to lose money.
The highest bar.
Okay, number 1, adequate size. Revenue is over $45 billion, so pass.
Easy pass.
Current ratio greater than or equal to 2. We are at 1.19, so fail.
Hard fail.
LT debt less than or equal to net current assets. We are way over, so fail.
Another hard fail.
Valuation, PE less than or equal to 15. We are at 33.2, so fail.
Big fail.
Valuation, PB less than or equal to 1.5. We are at 13.4, so fail.
Another big fail.
And the combo, valuation PC times PB less than or equal to 22.5. If you multiply 33.2 by 13.4, you get approximately 445. The limit is 22.5.
445 versus 22.5.
It is a spectacular fail.
That is a brutal scorecard. Verdict? Does not fit defensive. Not even close. It is too expensive and too leveraged.
Okay, let's try the enterprising investor checklist. This is for the investor willing to do more work and take more risk.
A lower bar.
Current ratio greater than or equal to 1.5. We are still at 1.19. Fail.
They'll fail.
Conservative debt versus working capital, still a fail.
Still fails.
Shareholder-friendly policy, looking at the buybacks. We see massive buybacks, so I'd say that's a pass.
Okay, one pass.
Price discipline, PE less than or equal to 20. Graham allowed up to 20 for quality. We are at 33.2. Fail.
So even for the enterprising investor, the big failures are liquidity and valuation. It is simply too expensive and runs too tight a ship on cash for a Graham disciple.
So if it fails the checklist, how far off is the value?
Yeah.
Let's calculate the valuation anchors and margin of safety.
Yes, let's calculate some conservative value anchors to see the gap between price and value.
Let's calculate the Graham number. This is a formula Graham used to find a rough fair value based on earnings and book value.
A classic back-of-the-envelope check.
First, book value per share, or BVPS. Equity of $26.615 billion divided by 4.2445 billion shares equals approximately $6.27.
$6.27.
The formula is square root of 22.5 multiplied by EPS of 253 multiplied by BVPS of 627.
And when you run that math,
The result is approximately $18.89.
$18.89.
Wow.
Comparison. The stock is at $84.
Yeah. The premium is massive. The Graham number suggests the tangible and financial backing of the price is very, very low. Most of the price is air. It's the expectation of future earnings.
Let's use the FCF yield anchors. We established FCF per share is about $2.23. If you demand a 6% yield, the value is $2.23 divided by 0.06. That gives you a share price of $37.15.
$37.15.
If you are willing to accept a 4% yield because of the quality, the value is $2.23 divided by 0.04. That gives you $55.72.
So our summary of conservative anchors ranges from roughly 19 to 56 cents per share.
And the stock is trading at $84. The implication is undeniable. At $84, there is a negative margin of safety using conservative fundamentals.
You're overpaying.
You are paying for growth that hasn't happened yet. If the growth stops, the valuation has a long way to fall to reach these anchors.
And let's play devil's advocate with a thought experiment. The downside sensitivity.
What happens if the multiple compresses? What if the market stops viewing it as a tech darling and starts viewing it as a mature media company?
Okay. If earnings stay flat at $2.53, just flat, no disaster, just no growth, and the stock re-rates to a 20x multiple, the price drops to $50.60. That is a negative 40% decline from 84.
40% gone, just from a change in sentiment.
And if it re-rates to a Graham Standard 15x, the price drops to $37.95. That is a negative 55% decline.
This illustrates downside sensitivity. When you start at a 33 times PE, the math is working against you. The only defenses you have are massive growth earnings, doubling or tripling, or permanently high expectations from the market. A 55% drawdown sounds extreme, but it is just a return to average valuation metrics.
We have compiled a red flag register. Let's run down the list of 8 specific red flags identified in this analysis.
Number 1.
Extreme valuation. PE of 33.2, PB of 13.4. The price is high.
Number 2.
Liquidity below thresholds. Current ratio of 1.19. The cash cushion is thin.
Number 3.
Debt far above net current assets. A balance sheet leverage warning.
Number 4.
Buybacks consume approximately 96.5% of FCF. This leaves reduced flexibility for other investments or cushioning bad years.
Number 5.
Asset concentration. Content is approximately 59% of total assets. Huge intangible risk.
Number 6.
FX and hedging noise in revenue. It obscures the raw demand signal.
Number 7.
Equity issuance and stock-based compensation dilution pressure.
And number 8.
Limited disclosure. We are looking at unaudited statements with no footnotes. We don't see the off-balance sheet commitments or the details on the content assets.
Given those flags, what are the leading indicators you should watch if you own this or are watching it? First, the CFO trend and margin. Is cash flow growing as fast as revenue? Second, repurchases as a percent of FCF. If they stop buying back stock, it might signal they see the price is too high or they need the cash elsewhere.
That's a big signal.
Third, current ratio trends. If that 1.19 drops toward 1.0, liquidity becomes a real issue. And finally, content asset balances and impairment signals. Watch for big write-offs.
It is time for the final verdict.
We are assigning the label, speculative needs caution.
The reason is grounded in the math. It fails liquidity tests. It fails debt discipline tests. And it fails moderate valuation tests by a wide margin.
And we acknowledge the strengths. This is not a bad business verdict. There is strong profitability. There is strong cash generation. There is a large buyback program.
But the core conflict is that the strengths are real, but they are priced in and then some. You are paying a premium price for a perfect execution scenario.
The final thought for the investor is this. At what price would this become a margin of safety situation? And conversely, what evidence would convince us the extraordinary margins are durable enough to justify the premium? You need to answer those before you allocate capital.
Thanks for joining.
If you found this useful, like the episode and subscribe. It really helps us keep these lessons free.